After seeing the stock market correct by over 20% over the last few weeks as the world panicked over Donald Trump's new tariff policies, the S&P 500 has now snapped back up by over 10% within a single day on the news that they will be pausing tariffs for 90 days for most countries except China. A 10% move up within a single day on the S&P 500 is something that has only occurred a handful of times throughout history, including at the end of the COVID pandemic, towards the end of the Great Financial Crisis, and right after Black Monday in 1987. So are we on the brink of seeing another stock market melt up over the next few months? Or is this big bounce just one big trap, with stocks set to move lower from here? Well, indeed, what has been driving the stock market lower over the last few weeks is not just tariffs by themselves. It is the potential that tariffs have to catalyze an economic recession. So the real question is whether recession risks magically go away if tariffs don't get implemented, or whether the path towards an economic recession is already set in stone, which would make stocks continue to move lower. One of the key defining characteristics of a recession is that the unemployment rate rises. All US recessions going back to the 1940s, without exception, have seen the unemployment rate rise. In fact, if we overlay the S&P 500 on top, these periods where the unemployment rate is rising naturally correspond to the largest drawdowns on US stocks. If we really are heading into a recession today, despite Donald Trump's pause on tariffs, that means we should see the unemployment rate rise during the rest of 2025 as we see what's called the labor market cracking. And again, if that's what's in store for us, that could mean that there's still plenty of downside left on the S&P 500, because as you can see, stock market bottoms during economic recessions typically don't happen until the unemployment rate has actually peaked. And that could still potentially be months from now. But before I make you guys panic, let me add one of my favorite macroeconomic indicators to this chart of the unemployment rate, and that is the yield curve. This is an incredible tool that gives us a lot of additional information regarding the state of the job market. As you can see throughout history, the yield curve and the unemployment rate tend to go in the same direction. Now, throughout 2023, the yield curve had been inverted, which is when it goes below zero, and in the past, that has been followed by a rising unemployment rate and a recession. And typically, the way that happens is that the yield curve does what's called a steepening, which is when it comes out of the inversion, and that's the signal that you're entering an economic recession and that you're likely to see the unemployment rate rise at the same time as the yield curve is steepening. But as you can see, over the last few months, we've actually seen the yield curve re-invert, meaning that it has stopped steepening. In fact, if we zoom in and we add the S&P 500 on top, we see that as the S&P 500 has declined, the yield curve has re-inverted. This is very different to what we've seen historically when the stock market is pricing in an economic downturn. For instance, in 2008, when the stock market was crashing, you had the yield curve steepen at the same time. This is what a textbook recessionary yield curve looks like. You had the same thing during the 2001 crash. As the S&P 500 was declining, you had that yield curve steepen. But for now, this yield curve re-inversion is telling us that the yield curve is not expecting the labor market to break just yet. So you might be wondering, what does it mean if the yield curve is re-inverting? That could look something like what happened in these instances right here. These were periods where the unemployment rate continued to trend lower as the economy did not yet enter a recession, and the stock market ended up doing quite well during that period of time. So to us, we're actually pretty constructive on the overall economic outlook right now, because this does not look or feel like a textbook recession. If tariffs are actually put on hold and trade negotiations do lead to favorable conditions for US companies, it could provide a pretty constructive macro backdrop for the economy and markets to thrive. So that's the positive side to the story that's telling us to keep an open mind about this being just a typical growth scare correction and not needing to panic too quickly about a recession as we're currently seeing on news headlines right now. That being said, there are always two sides to the story, and there is one signal right now that is keeping us on edge, and that is on an indicator called the gold to silver ratio that has just jumped up by 15% within a single week. As we highlighted in one of our recent videos, this is a major risk-off signal. because it tells us that traders are dumping silver, which tends to be seen as higher risk, for gold that tends to be seen as more of a safe haven asset. We've only seen a 1 week jump in the gold to silver ratio like this a handful of times going back over the last 20 years. We're right at the beginning of the COVID crash, right here before a 20% decline in 2011, and right here before a 50% decline during the Great Financial Crisis. So while we certainly don't think that investors should panic out of their positions right now, we're also not in a rush right now at Bravos Research to reallocate to stocks just yet. We're watching to see what happens, and we want to see solid evidence that the market is bottoming out before increasing our allocation to stocks again. You can follow all of our trades at Bravos Research. You can check out our homepage if you want to see all of the closed trades that we've had throughout 2024. We managed to lock in incredible returns throughout 2024 with our trades, yielding approximately a 60% annual return. That's twice that of the S&P 500. We think the rest of 2025 is going to have massive opportunities for investors. If you want to catch them with us, make sure you're subscribed to our service.